Hey everyone, Lovejote from Market Makers University here, and in today's video we're going to be going over multi-time frame analysis. And what do I mean by this? And what I mean is whenever you're looking at a chart, you should be looking at various different time frames to allow yourself to get an overall idea, an overall picture of the actual market, so you can look at it from various different perspectives to allow you to get better entries and better exits in your trades. Because as traders, what we're looking to find is the best optimal entries as possible and also the best optimal exits as we possibly can as well. So if you're one of the traders that are looking to improve your entries and your exits when it comes to the market, you're going to want to watch this video to its entirety, because in this lesson I'm going to be showing you what not to do, and I'm going to be showing you how to use multi-time frame analysis the correct way, and I'm going to be giving you a wide array of examples so not only you can learn this, but you can get really good at it. And by the way, I've had people message me and send me DMs on Instagram telling me that these videos are super helpful. By the way, the link to my Instagram is in the description below. But if you find these videos helpful, that's awesome. So just go ahead and grab a snack, grab a pen, grab a sheet of paper, take some notes, watch this whole video, and just apply it. Apply what you learn to your trading. Oh, and by the way, hit the like button as we roll the intro. Let's get started. So whenever we're looking at a chart, we cannot exclusively look at one specific time frame. We need to make sure that we're looking at multiple different time frames, because this allows us to get a different perspective, a different market idea of what's actually going on in the chart in front of us. Now, because if we only focus on one specific time frame, we're missing out on a lot of precious information that the market can be telling you. But if you're only looking at that one time frame, you're not receiving any of this precious information that will allow you to find better entries and allow you to find better exits in your trading. So now that you guys know why it's so important, let's talk about how to do this the right way. Now, most traders, most brand new traders, whenever they're looking at different time frames, if they do try to attempt to do multi-time frame analysis, they usually change the time frames to something that is very similar. I'll give you an example. Most brand new traders might switch from like the 1 minute time frame and then go to the 5 minute time frame, and then maybe the 10-minute time frame, and maybe even the 15-minute time frame. But if you look at it, you'll notice that if I'm looking at it on the 1 minute time frame, here's the chart on the 1 minute time frame, and then flipping to the 5 minute time frame, it's pretty much the same exact thing. And then even going to the 10-minute time frame, you'll notice it's still pretty much the same exact thing. And then even going to the 15-minute time frame, you still pretty much get the same exact picture. You're not receiving any new information. So this is the incorrect way to do multi-time frame analysis. Don't switch to a time frame that's very close to each other, because at the end of the day, it honestly doesn't really give you any new information. Now, the other thing I see traders often doing is they change the time frame to something way drastic, which does not have any effect in their specific trade that they're even looking to get into. So for example, let's just say we're in the 1 hour time frame. So a trader would look at this and they would straight go to the monthly time frame, which that's not useful at all. Because if you look at this one green candle right here, just as one vertical green bar, that is 1 month's worth of time. Now, going back to, let's just say, the 1 hour time frame, that one green candle that you saw is actually all of this information starting from the beginning of April. All of this information is contained within that one green bar that you saw at the monthly time frame. So that doesn't help you in your specific trade. So to do this the right way, you want to be looking to change the time frame to a time frame that's 4 to 6 times greater or smaller than the current time frame that you're actually on. So to give you an example, let's just say we're looking at the 1 hour chart right now. We're looking at the 1 hour chart. So you need to think to yourself, what's a time frame that's 4 times greater, 4 to 6 times greater, or 4 to 6 times less than the current time frame itself? So looking at the 1 hour time frame, an example of a time frame that's 4 times bigger would be the 4 hour time frame. Or going the other way, looking at the 1 hour time frame, Going 4 times smaller, that would be the 15-minute time frame. Why? Because 15 minutes occur in an hour 4 times. So now let's just say we're at the 4-hour time frame. We do the same type of math. We say, okay, what's 4 to 6 times greater or 4 to 6 times less? So if you look at it going on the less direction, that'll be the 1-hour time frame. And in the other direction, what's 4 to 6 times greater than 4 hours? Well, there are 6 4-hour blocks in a day, in a single day. So in that case, going on the higher time frame, that would be considered your daily time frame. And if you kind of do the math, if you wanted to see what's 4 times bigger than the 4-hour time frame, that would be every 16-hour blocks, which this is possible. You can do a 16-hour time frame, but traders generally don't do these type of time frames is because pay attention to this, if you're looking at a time frame that's smaller than a day, that's a daily time frame or less, you want to be looking for time frames that are multiples of a day, that divide into a day perfectly, that divide into a day evenly. So to give you an example, let's just say you were on the 1-hour time frame and you think to yourself, okay, so we're looking to change time frames between 4 to 6 times. And you think to yourself, okay, let's just do a 5-hour time frame. That would be a time frame that you would not tend to do, because if you look at it from 5-hour increments, 5, 10, 15, 20, 25, that doesn't equal perfectly 24 hours. However, on the other hand, the 4-hour time frame is divisible by 24 perfectly. And another time frame you can possibly do is even the 8-hour time frame. There are traders that focus on the 8-hour time frame. Why? Because 8, 16, 24. In fact, there are traders that even do the 12-hour time frame. While it's not as common, 12 goes into 24 evenly as well. So the main thing you want to understand is whenever you're looking at a time frame in less than a day, you want to focus on a time frame that's divisible evenly to the actual daily candle itself. Now, the next really, really important thing, I need you guys to write this, I need you guys to truly understand this, is the greater time frames. The greater the time frame is, the more weight it has, the more power that it has relative to a smaller time frame. So whenever you're looking at a trend, you want to be trying to look for what the trend is on a bigger time frame, what the market is telling you, talking to you on a bigger time frame relative to a smaller time frame. And by the way, I'm going to be going over and showing you examples of every single thing that I'm talking about. But just to give you an example, what I usually do is whenever I look at a chart, I look at the biggest time frame, let's just say monthly, and then I slowly start creeping down into smaller and smaller time frames. For example, I start from the monthly, go to the weekly, go to the daily, go to the 4-hour, go to the 1-hour, and just kind of see gradually kind of refining and fine-tuning the market itself and understanding what the market is telling me on all the bigger time frames itself. Why? Because the bigger time frames hold a lot more weight than smaller time frames. And the next tip, and this is a huge tip, if you guys see the market at a point where it could potentially react at a smaller time frame, and you are looking at a bigger time frame, and you see another reason the market might react in that same exact spot on 2 different time frames, that's going to give you what's called a confluence. And if you can look and pinpoint these small hot spots, these small little hot zones where you do find a confluence, these are going to give you a lot higher probability setups to allow you to enter that trade, to give you a trade that allows you to get to take profit. Why? Because various other smart money is looking at those specific areas as well, and they're looking to put their entries in that specific area as well. Some smart money might be looking at it from a different perspective, and other smart money might be looking at it from another perspective, but overall their idea is the same, even though they're looking at the market from 2 different types of techniques. So if you can find multiple reasons from multiple different time frames to enter a specific trade, that's going to give you a higher probability setup to allow the trade to go in your favor. And I'm going to show you an example of exactly what I'm talking about here. And the last key note I want to talk to you guys about is whenever you're looking at the charts, do not get tunnel visioned into only one specific time frame. I know it's very easy to always stay in, I don't know what time frames you guys trade in, but if you're trading in the 15-minute time frame or the hourly time frame or 5-minute time frame, it's very easy to get that tunnel vision and completely ignore the monthly time frame, the weekly time frame, and even the daily time frame. And these bigger time frames are what's probably causing you to lose a lot of money in the market because you're not paying attention to what's going on in the higher time frames. So do not get tunnel vision. So let's go talk about some examples. Now, in one of my previous videos, in the video where we discussed patience, I'll link it up here if you haven't watched that video. It's super important that you watch it. In that video, I gave you an example of a trader entering a trade, entering a short position right here, right in this area, looking to go short. So let me just kind of talk about how we're going to be using multi-time frame analysis to understand where we find our entry and where we find our exit. So the first thing we notice is that the actual trend, and by the way, we're looking at the 4-hour time frame at this point. If we notice the trend in the 4-hour time frame, the trend is going down. Here's the high. Here's another high, here's another high, here's another high. The highs are getting lower and lower and lower and lower and lower. And what's happening with the lows? The lows are getting lower and lower and lower and lower and lower. So the lows are getting lower as well. So the highs are getting lower and the lows are getting lower in the 4-hour time frame. So this kind of signals us to be able to look for a potential area to go short. Now, the next analysis that this trader did in this example that I gave you was looking at this area right here, creating a support area, which then flipped over into a resistance area, and we were looking to go short on the double top for the second resistance, right? So this was the actual entry itself. So this is the entry if you're analyzing it on the 4-hour time frame. However, if you kind of look back and go into the daily time frame, and you look at the same exact zone, which was a support, which turned into a resistance, you'll notice that same exact zone, the market reacted in that same zone in the past on the daily time frame, over here and over here. Let me kind of zoom in and get a little closer picture so you can get a closer idea of what I'm talking about. Right here, this area in the past and this area in the past as well. So that zone not only is a zone in the 4-hour time frame, but that zone is also a valid zone in the daily time frame. This is what I was talking about when I said look for an area if multiple different time frames give you a confluence. So this is why this zone, this trade here to go short would be a high probability setup, simply because the two time frames are talking to each other in unison. So now we're looking at this trade. Let's just say we entered the short. Let's say we entered the short going downwards. Obviously, we put our stop loss above the zone. And by the way, I talked about these zones as support and resistance in another video as well. Super important video. I'll link it right up here so you can watch that one as well. But let's assume that you've already watched that video. So let's say we take the short there. There are a couple places we can look to take profit. And matter of fact, let me just kind of put this little replay tool on, because I just kind of want to show you what like the thought process could be. Number one, the first place someone could be potentially looking to take profit would be right here, would be to create a potential, another zone right here as well for the market to potentially bounce back up. That's one area. So let's just say the trader did not want to take profit there, simply because they're anticipating that the market is continuing to create lower highs, and the market is also anticipating to create lower lows, looking for another potential lower low, which is a very valid thing to kind of think about, right? So they could be thinking the market might create another valid lower low. So another potential area that the trader might look to take profit is this zone. They might look at this and say, you know what? I feel like the market might reject off of this. And the next thing that I'm thinking is that the market is probably creating lower lows. So I feel like I'm going to be entering a short and only looking to take profit if the market reaches down here, which is a very valid way of thinking, looking at it from the 4-hour time frame. However, this is where most traders mess up, because this is tunneling yourself to only look at the 4-hour time frame. Now, let's take a step back, and now let's look at what's happening in the actual daily time frame. So it's taking a step back, looking at the daily time frame. I'm going to ask you a question. Which direction is the overall trend going in the daily time frame? Well, in this time frame, the market is going in the up direction. It's an uptrend. So if you're looking at the daily time frame, it's going in the uptrend, and we've entered a short. We're kind of trading in the opposite direction of the trend. But obviously in the 4-hour time frame, this is completely fine, right? We're trading in the direction of the trend, we're trading down. So this is an okay trade. It's not too bad. But just know that the market in the daily time frame is trending in the up direction. So we need to be anticipating how far down the market could potentially go before potentially bouncing back up. So how do we determine this? So one of the ways that we kind of determine this is being able to look at the actual trend and draw an actual trend line and kind of see where the market could potentially bounce off of. So if you draw the trend line on the way upwards, connecting all of the wicks, like I've taught you guys, you'll see that the market is trending upwards, and the market might have a potential struggle being able to pierce this area and then continue downwards, whereas it has a higher probability of touching anywhere in this area and bouncing right back up, going in the direction that the overall trend is actually going. So whereas had the trader taken their take profit here, if the market does end up bouncing on this trend line, then this take profit would have never even been hit. So that exit would have been a terrible exit. So let's just kind of go into the 4-hour time frame and kind of see this market play out. Okay, so the market hit our trend line. So this would be an area where you would want to take profit right here. Why? Because the market in the daily time frame has reached the same exact trend line going in the up direction. Matter of fact, this would be a perfect area to go to close your trade. In fact, if you were a trend trader, what you would also want to do is this would allow you to give you a also low risk trade to do what? To trade in the direction of the actual trend. So as soon as you close your short here, if you were trading in the direction of the trend on the daily time frame, what you could literally do is you could end up looking to go long, enter a trade going in the up direction, literally the next few candles afterwards. This trade would close here, and then this trade would start here, looking to trade in the up direction. Obviously, your stop loss could probably be below this zone here. But in this case, if you were trading in the direction of the trend, looking at it from the bigger time frame, why? Because the bigger time frames hold more weight. The bigger time frames are respected more than the smaller time frames. You would want to be looking to take a long here rather than continuing the actual short. Because yes, the trend was going short in the 4-hour time frame, but in the daily time frame, it's going up. So let's just kind of go ahead and play these next few candles out. That's definitely going up right off of that trend line, looking to go in the up direction. So this would have been a beautiful trade. In fact, this would be a beautiful trade to not only hold up until this specific area, but also to hold potentially long term, simply because you got such a sniper perfect beautiful entry going in the direction of the trend. This would be a trade where I would hold this, I would move the stop loss, to break even. This way, if the market does end up coming back down, I won't lose any money. But this would be a trade I would take partial profits here and continue to try to hold this even longer, just allowing myself to eat up as many profits as I can, trading in the direction of the trend itself. Because if you go ahead and continue to hit forward, you go to the current price action itself, that same support and resistance area, you'll notice that resistance area that was created has now got pierced. So depending on how this market closes, this could potentially be an area that the market could rally even higher. So this is an area to kind of look at. But this is the entry that you should have taken had you looked at the 4-hour time frame and the daily time frame, and you would have known exactly where to put your take profit for the trade going in the short direction. Because if you're not looking at the daily time frame, you would not have seen this trend coming in, and your trade would not have hit your take profit had you done it down here. And this also would have been a very beautiful trade that you would have missed. And that would have been very, very, very unfortunate, because that right there, that's 300 pips profit on Euro USD. And you would have had how much of a drawdown? This would have given you a 15 pip drawdown to give you a 300 pip take profit. Beautiful, beautiful trade. Another example I want to give you is on EURJPY. I want you to look at this. So looking at this on a 4-hour time frame, you can notice that right here there is a resistance area being formed right here. This area right here, the market is bouncing off of this area multiple times. It bounced off once, twice, 3 times, 4 times, and then at one point it did end up piercing this resistance area to go above it. So what did we talk about in the support and resistance video that I released a couple videos ago? We talked about that same resistance area could potentially turn into a support, right? So you would want to extend this all the way into the future, all the way to the right. And you'll notice that had you waited patiently for the market to approach this area as well, this would have been an area for you to go long, to enter a trade in the up direction, looking at this resistance area, which now turned into a support. So that's looking at it from the 4-hour time frame. Now looking at the same concept, the same trade, the same area from a different perspective, let's just say the daily time frame perspective, you'll notice same exact concept. The trend is going up. The overall trend is going up. And we also saw that the resistance now could potentially turn into a support for a buy, which is also in the favor of the actual market trend itself. And secondly, if we draw an actual trend line hitting all of these little wicks here, you'll notice this would have been an area of confluence, as I mentioned earlier, that this little pinpoint spot right here, let me kind of zoom in, that this pinpoint spot, this small little area right here where these two areas intersect, this would have been a beautiful area that has confluence to allow you to see that this could be a very high probability setup to go long, to enter a trade in the up direction. Those are the two reasons that this trade would have been a low risk entry to allow you to net a lot of pips, that where you could just ride it on the way up and allow this stop loss to be below these zones and just ride this trade to however long that you want to allow this trade to continue to run for yourself. Now, another example I want to give you is on EURAUD. If you look at this actual chart itself, you'll notice that this market was in a downtrend, right? We all agree that the market was trending down, right? So let's just kind of go zoom into the 4-hour time frame. I want to talk about something here. You'll notice, if you were just looking at the highs and the lows, you notice the highs were indeed getting lower and lower and lower, and so were the lows. The lows were also getting lower and lower as well, right? So if you're looking at this on a 4-hour time frame, if you waited and you noticed, just waiting patiently, that you noticed this high didn't get lower. I'll show you. This high wasn't lower than the previous high, right? You would expect this high to be even lower, and you would expect the market to go even lower. Obviously, that wasn't the case. So you'll notice the market created finally a higher high. This time, the high has gotten higher than the previous one. So now this could be a signal, a sign that the market could potentially be reversing. So that's looking at it in the 4-hour time frame. Looking at the same concept at the daily time frame, you'll notice if this market was trending downwards, you can see, you can picture this as a channel going in the down direction. You'll notice this actual channel is going downwards, and it's creating kind of parallel lines, and the market is essentially bouncing between these two areas multiple times, and you'll notice even on the bigger time frame that this high that we saw, that this high has actually exited the channel, which is also another clue that the market could have potentially reversed. So when you notice that, now we need to figure out where could we potentially find an entry for this setup. We know that the market potentially has flipped. We know the market potentially going back up. So now we need to figure out how do we actually find our entry. So we go to the 4-hour time frame. We notice that we have the highs that we kind of looked at, but now looking at it from the daily time frame, we notice that if the market was up here when we looked at it, if you saw the market has created that high and it bounced back down, we need to kind of look at it and understand where should we enter the long, where should we enter trading upwards, since we're assuming that the price might potentially go up. An area that is a high probability that the price might go up is on the bounce, on the retest of this channel. I've talked about this in one of my previous videos as well. So you would patiently wait for the market to slowly creep down and get to a point where it touches the top of this channel to allow you to enter that long. So what do? We just patiently wait and see what the market unfolds. So that right there, that would have been our entry to go long and putting our stop loss somewhere conservative and allowing ourselves to enter a long. And where could we take our profit? Potentially on this high over here. Or once we take our profit here, leave partial profits continuing to run to allow yourself to maximize the pips that you could potentially be gaining. So had you taken your profit there, that trade would have been finished. That's 200 pips on the dot. Or if you left some of it running, then that trade could have potentially just kept running for you to achieve even more profits, just waiting to kind of see what the market does. So that's another way. So whenever you're looking at multi-time frame analysis, don't just be looking at only the examples that I've given you in terms of waiting for two support and resistance areas to line up on the 4-hour or daily time frame. No, look at various different factors. Look at and see if different trend lines line up in other different ways. Maybe a 4-hour trend line lines up with a daily trend line, or maybe a 4-hour fib matches with a daily fib. Fib is the Fibonacci, right? If these different things line up in different time frames, that gives you higher probability setups. Or maybe even if you have various different indicators, maybe if an indicator that's in the 4-hour time frame lines up with an indicator in the daily time frame for you to enter your trade, that's also a sign to give you a low risk trade that gives you a high probability setup to enter your trade itself. So I've given you a wide range of examples on how to use multi-time frame analysis. You can use this technique to understand, to allow yourself to get the best entries, and also to allow you to understand where you should exit and where you potentially shouldn't exit. On the example that I gave you on Euro USD. Right here, right? This would have been a terrible exit had you not looked at the daily time frame, and also gives you an idea how to find the best entries as well to allow yourself to get these sniper entries. And I showed you how you can use confluences to allow you to understand, to give you higher probability setups, because if big money is looking at a time frame at 4 hours and other big money is looking at the time frame on a daily time frame, they both have the same analysis, but they're looking at two different reasons to go long. Example, in the EURJPY example, two different reasons to enter this specific trade right here. You'll know that if big money is looking to go long here, this is a very high probability setup for you, because someone could have been looking at it to go long off the break and retest of the zone, and other big money could have been looking at it to go long on the trend line itself. So as long as you can find confluences, that's going to give you high probability setups to make money in the market. So I truly hope this video was helpful. And I'm telling you, you guys need to watch this video multiple times to understand and practice exactly what I'm showing you. Don't just watch this video, actually practice. Practice what I'm showing you so you can get better and better and better. And if you found this video helpful, if you actually learned something in this video, I just ask you for one favor. Just go ahead and hit the like button on the video if you haven't already, which you obviously should have if you've gotten to this point of the video so far. And for those of you that aren't subscribed to the channel itself, definitely feel free to subscribe, because we release content like this multiple times a week. Multiple times a week we give out free value. But again, thank you for watching the video. Stay tuned, and I'll catch you guys in the next video. Take care, guys.